Good afternoon, everyone. Thank you for joining us today. This is our first webinar, and we're hoping to do these more frequently. So we appreciate everybody who's joined, and this will be recorded. So we do plan on disseminating this information. At this time, am going to turn it over to Ryan Quirk, one of our newest members here at Strategic. And he has put together this webinar in conjunction with some of our partners that we work closely with. You may recognize, some of you, the name Horizon Investments. They're one of our strategic partners, and many of you on the call have one or more of their portfolios. So without any further ado, I would like to introduce you to Ryan Quirk.
Thank you for the very kind introduction. As mentioned, my name is Ryan Quirk. I serve as the Director of Process Improvement here at Strategic Financial. Previously worked as a manager of strategy and consulting at Accenture Asset Management. So it's been a bit of a change, but really liking things so far at Strategic and hoping to continue to push things like this forward in the future. We think this is a very valuable offering. So also joining us today are John Bryant and Austin Fitch of Horizon Investments. They both have earned a CFA designation, and we just have a wonderful relationship with them, and they've helped us immensely as a firm. Their main focuses are on creative investment solutions, portfolio construction and management, as well as fund research and selection. But that doesn't even do them justice. They are men that wear many hats. So without further ado, I'll kick it over to them and they can get things started here.
Awesome. Thanks, Ryan. Thanks, Regina. And thanks, Mike, for having us on. Really appreciate just the opportunity to get into the conversation today. We do have some slides that we'll use to really guide today's conversation. So I'll bring those up as we're getting started here. And with that being said, just a couple of kind of housekeeping items as we're getting ready to go through this deck. One, if you have questions as we're going through kind of a market and economic outlook, don't hesitate to ask. You have the ability in the chat feature, the Q&A feature there as part of Zoom to ask those questions. We'll try to get to as many of them as possible as we go through the deck. And then we'll address any of those that we don't touch on at the end. Also, and I'm sure Ryan, Mike, Regina would all agree, if there are further questions, we'd be happy to address those offline after this call or after you're watching this recording. So don't hesitate to reach out and ask questions. That's kind of the goal of this next 30, 45 minutes, is to really provide kind of an informational overview of what we're looking at here at Horizon to give you a sense of kind of the market and the economy as we head into the back half of 2024. But again, really to spur conversation as part of that discussion. So with no further ado, we will jump right in. From an agenda standpoint, you'll see really 4 or 5 kind of broad topics that we're going to cover today. And we've got a couple slides on each, so we won't take too much time on any one specific topic, but want to make sure we hit the highlights. And a lot of these things you're probably hearing about in the news or in the headlines, so we want to make sure we touch on them. And really get into, like I said, some of the research that we're getting into here at Horizon. So AI being the first conversation piece. So John, I'll toss it to you, and John's gonna kind of be the subject matter expert for a lot of these as he sits on our portfolio strategy group team and really dives into portfolios like Ryan mentioned, but also the economy and the market more broadly. So John, tell us this AI conversation that we've heard so much about in the headlines just over the last couple of years. Why is it that important? And maybe specifically, why is it important now as we talk about it?
Yeah, thank you so much, Austin. And again, I want to thank everyone for joining today, and we're really looking forward to this opportunity. I think as it relates to artificial intelligence, we are thinking about it from a broad macro view and how it can impact the overall economy, and particularly inflation. And if you're really going to think about it this way, you have to go back to Macroecon 101. And so this is just a standard supply and demand curve. Your supply curve is upward sloping, and your demand curve is the downward sloping line. On the y-axis or the vertical axis, you have prices, and on the x-axis, you have quantity. What is artificial intelligence? Well, it's a form of technology. What does technology do? Well, it actually increases the efficiency of production processes. What does that mean? It means generally, in theory, supply curve gets shifted to the right, which means you are able to produce more goods and services. If demand remains constant, your quantity produced increases. Why this matters is you'll see on the vertical axis, prices come down. And why that matters now is because we've been in a very volatile inflationary environment. And you might remember through the 2000s and the technological advances back then, we didn't have inflation really rip and roar like it has been more recently. And we think artificial intelligence, if you think about it as another form of technology, it can be an inflation dampener in the future.
That's a great point, John. And I think kind of your point about looking back historically is also important as you talk about kind of this productivity component that's associated with AI. Maybe walk us through this chart and let's talk about productivity and what it actually looks like in practice going back, 30 plus years.
Yeah, so I think when you also think about artificial intelligence, we've tackled it from an inflation dampener standpoint, but I think there's a good growth side of this too. One way you can measure productivity, or in other words, doing more with the same, is sales per employee. So what this is looking at is broad, large companies, are they able to produce more sales or revenue per employee? And you'll notice it's cyclical. It's not always up and to the left in a linear fashion. There are oftentimes many years, for instance, where productivity gains don't happen as quickly, but we are actually in the midst of one, basically coming out of COVID. And we think this line has a good chance to continue to go up in the same direction it's been trending with additional artificial intelligence releases.
No, that's a great point, John. And something that, again, as you're hearing more in the headlines about kind of this AI revolution, as John mentioned, we think there are a lot of kind of valuable components that this will bring to the economy at large. But then, as we'll talk about a little bit later, okay, what does that mean for the market and individual, stocks as we're looking at opportunities on a go-forward basis? So that being said, we will transition a little bit out of the AI conversation into kind of the broad economy. And another headline or phrase probably that you've heard for quite some time now is this idea of soft landing, right? And it's the idea that coming out of COVID, the economy kind of got supercharged there for a bit, led to really that uptick in inflation that John touched on just a second ago. But we're starting to see that come down as we talk about, inflation getting back down to normal, growth getting back down to normal. John, we've got a number of charts and graphs on this page. So let's walk folks through exactly what they're looking at and maybe why it's important.
Yeah, so you may hear terms like soft landing, hard landing. I would just say that the economy in aggregate never has a landing. It really just continues to move. But what a soft landing is are you able to raise rates? Is the Federal Reserve able to raise rates to cool inflation, to bring it back to normal levels? And are you able to do that without killing growth and without making huge disruptions to the labor market specifically? And I think what you're seeing here is that soft landing scenario does seem a little bit more likely. So just looking at the line charts on the right, inflation, which we know prices are way higher than they were pre-COVID, but the rate at which those prices are going up is falling. That's generally what you would hope to see as a result of these rate hikes. Not only that, we're starting to see consumption patterns starting to slow and really come off their all-time highs in 2021, 2022. Meanwhile, gross domestic product, or the overall economic output, continues to actually grow. And it is slowing, right? But these are all symptoms of what happens typically after a Federal Reserve raises rates. This is all part of what they were trying to accomplish.
Yeah, and I think that's a great point, John. And kind of the next slide is an extension of that. This idea that we've got an economy that is starting to slow down or cool off, if you will. But I think one point that we would want to make is kind of the title of this slide. things are cooling off, but they're not necessarily cold. And that's a really important distinction as we talk about the economy at large, is this idea that there've been a lot of questions, and I think a lot of questions were had maybe even 12, 18 months ago about this recessionary environment and the risk that we would head into a recession. I think the point that we're making here, John, is that whether it's the data on the previous slide or data that we're looking at on this slide, yes, things aren't necessarily as hot or as supercharged as they were coming out of 2020 into 2021. But they're also not necessarily a recessionary indicator at this point either, right?
Yeah, this is a really big thing when we think about broad economic output and really where we're trending. One of the things our team pays attention to is specifically wages. You might remember in 2021, 2022, many folks were quitting their jobs and getting large salary increases, and that actually has a funnel effect into spending more of your money. And all of a sudden, money velocity is really starting to pick up, and that actually has a direct input on inflation. We wanted to see wages come back down to a normal level, because that really ensures that there's not a wage price spiral, which we're going to walk through on the next slide.
Yeah, I mean, I think that's a great point, John. It's this idea of, right, if wages are growing at such a high rate, then you oftentimes do see folks raising prices to match kind of that higher wage that folks are I would say, normal workers in the economy are getting. And we would say there's kind of this sweet spot where wages are still going up, but you're not seeing the price increases nearly at the level that maybe that would cause that wage price spiral. So John, maybe talk us through obviously where we were in 2022 and then where we are now.
Yeah, I think you can definitely see the more real-time data, the more recent numbers on the right have showed that we were well above trend in this normal long-term. Now, really what we're showing you guys here is actually labor costs. So think of this in total payrolls, but this is year over year change. And it just kept getting higher and higher and higher in 21 and 2022. And that really did have a super large impact on the future inflation readings that we saw in 21 and 2022. And likewise, with some of the recent inflation readings we've seen now falling, it's been in line with what we've seen with wages. I mean, I think it really does start with wages when you're thinking about inflation. And there is a bit of a Goldilocks effect where if you can maintain this sweet spot, that's a pretty good spot to be in.
Yeah. So John, we've talked a lot about kind of economic data at this point, and you hinted earlier at kind of the soft landing scenario, this idea that interest rates have been hiked to a point where we really haven't seen them in quite some time. Another, again, phrase maybe that folks have grown accustomed to or have heard in the headlines is that idea of higher for longer. Yeah. And really what they're referring to there is the idea that we're going to experience higher interest rates for a longer period of time. And I would say this on the front end, and John, you can chime in too. I think a lot of folks are concerned that we have an economy that maybe can't stomach that or can't stand that, and will start to crumble under the pressure of those higher interest rates. I think we did some work, John, on looking back historically, and history would tell us that's not necessarily the case.
Yeah, a really good example of this is the mid-90s. And, it's always nice to be able to find a historical precedent for just to help you gain some context and how to think about where we are today. I think similarly, the technological advances from the mid-90s is a really good anecdote to talk through, but just talking about what the Federal Reserve did back then and how long rates were high for. I mean, just think about this. So in the mid-90s, we really raised rates from 3% to 6%. And it's not like they fell back down to 3% right away. I mean, they stayed elevated for several years. What you don't see is, and what you may not remember even experiencing, we didn't have a recession during that time. So it's not a guarantee that high rates are going to be a cause of a recession. And it's not to say that stocks can't actually outperform in this environment either. We are 2 years removed from when the Fed started to raise rates in 2022, and we are pretty much sniffing all-time highs in the stock market and a lot of those broad risk assets.
Yeah, that's a great point, John. And this idea of kind of higher rates has also led to conversations of what we would refer to internally as a maturity wall. And what that really means is, okay, at some point, these rates that folks were able to lock in pre-2020 or pre-rate hike cycle, think of it as maybe you refinanced a mortgage, or a corporation was able to lock in an interest rate, say in 2018, 2019, maybe even 2020, and they locked in a really low rate. I think the risk from a lot of folks is that at some point you got to refinance that debt or that mortgage, for example. Is that going to be a problem if your rate goes from 3% to 6%? And John, the data that we're looking at here, which there's a lot on this page, the data doesn't necessarily suggest that that's an imminent risk. Is that right?
Yeah, it's not an imminent risk. It is a risk if we remain high for several years, but it's not a risk now, and it's not a risk next year or even the year after. And the way you can see that in data is the top right chart is going to show investment grade corporate credit, and this is basically large companies, AAA rate, or highly investment grade rated companies actually issuing their debt. If you look at their debt outstanding, you can look at it a number of ways: the number of loans, or actually their loan value. Most of these loans basically mature in 2028 and higher. So if we are in this period where we are now in 2028, it's more of an issue. We do not see that as being an issue in the near term by any means. And the same applies for the high yield corporate credit universe as well, which is what you're seeing in the bottom right chart.
Yeah, that's a great point, John. And I think, again, makes for great headlines in terms of this idea that refinancing debt is going to cause kind of a crumbling economy, because you're going to have to refinance at a much higher rate. But to John's point, that's just not something that's imminent from an economy standpoint. That being said, we do want to address some of the, again, maybe negative headlines that you have seen. Is that idea that we started to see an uptick in delinquencies. And John, I think this one is maybe where math can work against us in the sense that as we had a former PhD on staff that used to say that if you torture the data long enough, it'll confess to anything. And I think this is a great example of that, because from a math standpoint, you can paint a very different picture than what we're looking at here.
Yeah, you may have seen some headlines about credit card balances getting out of control and bank charge-offs looking, increasing, looking scary. What I would say is, like, these lines have come up, right? Whether you're looking at 90-day delinquency, 30-day, 60-day, 120, they have come up from their lows, but they're still very low by historical standards. Why does this matter? Well, it's a really good view into consumption patterns, but I would say is, let's say we do enter a period over the next year of slowing economic growth, and we do see unemployment rate rise a little bit and recessionary fears pick up. If we are at this starting place versus, think about where we were in 2007 and 2008, it's a very different picture. And that, if you have a better starting place, it actually helps you as an overall economy navigate that recessionary period a lot more smoothly.
Yeah, that's a great point, John. And I think as we kind of transition from the broader economy and kind of the corporate side of things, we can look at it, and I think that's a great slide to transition us into the consumer, because we've heard a lot of kind of negative press about a consumer that's stretched or struggling. And just like that last slide, like, the underlying data just isn't really there to support that narrative.
Yeah, I think it would be hard for me to be convinced that the consumer is struggling at this point. One way you can think of this, if you think about it in your own lives, if you're working with the Quirks and Strategic Financial Services, I imagine your net worths are a little bit higher than when you started. And that's largely because of risk assets are up and home prices are up. And I would just say, if you're looking at it relative to just personal income, this is a pretty good spot to be in right now. And this is another sign that if we do even broadly enter a slowing period of economic growth, the consumer is going to be able to help us spend our way out of it.
Yeah, no, I think that's a great point, John. And I think Like there's a lot of different charts that we could look at that would speak to the strength of the consumer. Another one, really that speaks to maybe just kind of the ability of the consumer to spend if we get in that scenario, John, is this idea of cash on hand. So we're looking at checking, savings, money market,
Yep.
and history would suggest, again, you've got a consumer that's kind of flush with cash right now.
Yeah, this line, so this is a very long-term trend line. So the dashed line you're looking at this is average over decades. And what you're going to notice is there's been a huge divergence with more recent data relative to this average trend line. This really picked up in 2020 as a result of some of the COVID stimulus, but it's remained high because of how high yields are with money market accounts, not necessarily savings or checking accounts, but money market assets specifically. Suffice to say is consumers actually have a lot of cash, and it's valuable to have because there is buying pressure when some of that cash comes off the sidelines into risk assets.
Yep. No, I think that's a great point, and I think the next one tells the same story. It's the idea of, right, either you have a lot of cash on the sidelines or kind of that rainy day account, if you will, or John, to your point earlier about having maybe equity built up, homeowners have seen a massive benefit over the last, let's call it 15 years at this point, but even over the last few years, you've seen another uptick.
Yeah, if you are a homeowner, you should be patting yourself on the back. And certainly if you have a rate under 3.5 or 4, it really is the best inflation hedge there is, if you think about it. Homeowners are sitting on low mortgage rates from an effective mortgage rate interest rate standpoint, but also just record high home prices. It's been a difficult environment for a first-time home buyer, and I sympathize. But the aggregate consumer, the average homeowner, is doing pretty well right now.
Yeah. So, John, we've talked a lot about the strength of the consumer and some of those underlying data points, which again would paint that picture of strength. That being said, I think we all know that the consumer still views the economy within a negative light. And I think that brings us back to the inflation conversation. And this is one where it's a little bit nuanced, right? We're getting into the true definition of how you measure inflation, and anybody that pays attention to the consumer price index or the personal consumption expenditure index, like there are ways that are measured formally by economists, and then there are ways that Main Street individuals feel about inflation. I think this chart paints that picture pretty dramatically. And John, let's kind of help folks unpack what we're seeing and then how that translates to what we're feeling.
Yeah. So just think about where prices are today versus where they were pre-COVID. If you're looking at your grocery bill or any part of your budget, it's likely a lot higher than it was pre-COVID. And I bet you this blue line is kind of similar to what you're personally feeling. But when you think about what inflation actually is, it is measuring a rate of change. And that's really what economists look at is, yes, prices continue to go up, but the rate at which they are continuing to increase is falling. And that's where you're starting to see that red line. The one thing I would also echo is from a financial planning context, you can see, CPI was up X over X, CPI is averaging 4% per year. That may not be what your personal inflation rate is. And like I mentioned earlier, if you have a 3% mortgage or 3.5% mortgage back in 2021, I bet you your personal inflation rate was actually a lot lower than what CPI was reporting. So it's always good to look at broad aggregate data, but especially as it relates to spending behavior and inflation, there are planning important considerations to be made for an individual versus just kind of what you're broadly seeing.
Yeah, John, and one thing I would chime in on this slide too is this idea of kind of normal long-term inflation, to your point, measured in that red line, is anywhere between 2 and 3%.
Yeah.
So we're getting back into that normal range. That being said, to your point, it still feels like things aren't normal if you're judging, 2019 or 2020 as normal. That being said, some conversations that we've had with folks is look back over any 10, 20, 30 year period. I think we would all agree that inflation works the way that inflation works is that prices go up over time. Now,
Mhm.
generally speaking, as we kind of showed earlier, wages also kind of track that and mirror that. So I don't think we're ever expecting inflation, or I would say it this way, maybe.
Prices.
We don't want prices and inflation to come down. A deflationary environment actually is pretty, maybe even more challenging than inflation. You just have this time period where folks are getting accustomed to more broad-based or widespread inflation for the first time in really quite some time. So, John, we talked about kind of the economy. We've talked about the consumer. Now we've hit on inflation. Unfortunately, now we gotta touch on the election. And I think for probably most folks on this call, you may feel like the mom there on the right-hand side when it comes to the election conversation, just with all the rhetoric that's going back and forth. Obviously, the tragic incident from this past weekend, regardless of which side of the aisle you're on. And again, we're not going to go down any one specific path today, but what we've seen is just a heightened sense of volatility around this election. And because of that, obviously, there's some headline volatility, there's some market volatility that we've experienced even just in the first 6 or 7 months of the year. So, John, maybe explain this chart on the right as we're talking about that volatility and what we're seeing there. And then the next slide will actually maybe unpack some of the implications of the various kind of candidates.
Yeah, so all this line chart is showing, going back to 2022, is who's going to win the presidency in 2024. So you're going to notice the blue line represents Joe Biden and the orange line Trump. More recently, Trump has really surged in these percentage of odds, and especially very recently with especially after the debate. And what I would say is, in any election year, there's going to be a lot of volatility. It does get smoothed out after the polls and after the election. And generally, markets actually, when uncertainty comes down, total returns typically go up in a typical election year. But there's a lot to pay attention to. But keeping in mind that this election year versus other election years, it actually hasn't been as volatile as you might think. And a reason for that is because we already know what to expect. Both of these nominees have been president before. So it's not like there's going to be necessarily a new face here.
Yeah. And John, one thing I would call out on this slide too is the stats that we highlight there on the left-hand side. These are some survey stats of the consumer. Actually, I should say of the kind of voting populace. And why we highlighted those is because we just wanted to show everybody here what the voter feels or believes kind of in their core being. And now look at those stats and then think about what we just talked about over the last 20 minutes or so. And what you'll realize is they don't exactly line up. That being said, don't be surprised if both candidates on either side of the aisle really dive into or take advantage of the fact that folks feel this way. So you're probably going to hear even more and more over the next 2-3 months about kind of how things maybe aren't going as well, or there's certain areas of the economy that aren't doing well. Inflation, you're going to hear that, I'm sure, time and time again. All of that being said, again, it's not necessarily as bad as they're going to make you believe, despite some of that rhetoric that's going to be front and center for the next 3 or 4 months. So, John, we talked about the idea of, volatility. One thing we've talked a lot about in the past is, elections don't really drive markets. At the end of the day, you can look historically, again, who ends up in the White House, which party ends up with a majority in the Senate or the House, doesn't really drive broad market outcomes, but it does maybe drive some individual component parts of the economy and of the market. So help us kind of unpack that as we're looking at this slide.
Yeah, I know there's a lot of noise on this slide, but to echo what Austin is saying, we would recommend, to the best of you can, you vote at the polls and not necessarily with your portfolio. There is going to be a lot of volatility and noise up until the election. But if you are interested, I mean, this is interesting research from one of our our research partners, RBC Capital Markets. If you're looking at the charts on the left, now this is actually implications of US election scenarios. So the way you would read this is the data below the green bars is the total amount of some form of bullish. Bullish meaning good for stocks. The data above the red bar is the total amount of some form of bearish or feeling bad about stocks, the prospect for stocks. What I would say is actually the most positive scenario is the Republican sweep. So that would be Trump winning the presidential election and the Republican Party being the dominant party in Congress. But the second most positive scenario actually is Trump winning the presidential election with a split House and a split Congress between the Republican and Democratic Party. So this is definitely interesting data to look at. And if you care about individual sectors as part of the overall stock market, there is some nuance there. If Republicans sweep, generally your more cyclical sectors like energy, financials, consumer services or communication services and consumer discretionary, those look to be a little bit more bullish than some of others. I think just broadly, we would say is we're going to be paying attention to how the polls are reading, but you got to be careful about not influencing your portfolio with so much noise.
No, I think it's a very important point, John, to your point earlier. Yes, Republican sweep or even Trump in the White House maybe are the two kind of most bullish scenarios. But if you look at bearishness really across the board, there's minimal bearishness regardless of the outcome. And that's kind of what we're getting at there.
And the reason for that is because the economy's been so resilient and fundamentals have been so strong too.
Yep, for sure.
That's going to drive more of it than the election.
Yep. So if we look at kind of, okay, what's the implication for the market? And that'll be the last kind of couple slides that we've got here before we take some questions here at the end, is we've talked about this Fed activity, and the Federal Reserve, for those of you that maybe aren't as familiar, is kind of the body that sets short-term interest rates for the economy. Think baseline interest rate for how you price loans, how you price mortgages, how you price corporate debt that gets put into the system. That being said, John, maybe let's talk about this idea of kind of Fed angst and what that means and maybe what it has meant over the last kind of 2 or 3 years.
Yeah, what is the Fed going to do is really what this angst is. And I would just say this line chart is a measure of where rates, how high rates are going, and then how long they kind of stay high for. And some of that is still uncertain. And I think that's why you're still reading the more recent numbers aren't anywhere close to what it was like pre-2021. So there's still some volatility. There's still some uncertainty around this. But I think if you understand what the Fed is going to do, you have to be knowledgeable about that they have two mandates. One is price stability, getting inflation under control, and two is achieving maximum employment. And those mandates don't always go hand in hand. But what I would say is our firm view is that we are basically looking at the light at the end of the tunnel, and we can expect to start to see a cut because inflation has come back down as much as it has, and the fact that we're starting to see some cooling data with the labor market.
Yeah, no, that's a great point, John. And I think that then kind of translates into markets more broadly. And to your point earlier about, markets really maybe not being fans of volatility and liking more of the certainty that comes with whether it's lower interest rates or just having a better picture. One thing, though, that, talk about volatility, you've definitely seen some upside volatility in those technology stocks. For those of you that maybe are familiar with names like NVIDIA or Microsoft, Facebook, the Google's Alphabets of the world, I should say. And that goes back, John, we talked about kind of the late 90s scenario and some of the similarities there. However, you do see some differences in terms of, yes, the tech sector feels like it's maybe a little bit stretched, but history would tell us we're not anywhere really that close to what it would look like in the 90s.
Yeah, I mean, you might think with some of the run up that these Magnificent Seven or tech names have had has been similar to what it was like in the ongoing days of the tech bubble in the late 90s and early 2000s. Looking at this chart just does point out that, yes, there's been a really strong run up, but it's not to the extent that it was back then. And when you're looking at individual stocks, a lot of people look at PE ratios and valuations. And is it just getting more expensive because more people are buying it? Or is there any reason to believe in it continuing to grow because of fundamentals? And when I say fundamentals, that's when you're looking at, well, how much money are they making? How much money are they growing top line with revenues? How much money are they keeping with earnings? I would say these stocks have done really, really well because their fundamentals look so strong.
No, that's a great point, John. Last slide in terms of kind of markets is something that a lot of folks have maybe struggled with over the last couple years, and that's one where this idea that bonds have historically, and I say historically, I should say maybe within the last 20 years, really come to be kind of that ballast of a portfolio, right? You have a portfolio, it's got some individual equity positions, it's got some bond positions in it, and they typically work with an inverse correlation and kind of play off one another. John, we've seen just over the last couple of years, really that start to break down. But if you look historically, there's a long period that looks a lot more like the last couple of years than maybe let's call it 2000 to 2020. So maybe to help folks understand that, explain it to them.
Yeah. If you're looking at your portfolio and you think, well, I got stocks and I got bonds, I'm pretty well diversified. Sometimes you are, sometimes you aren't. And really what that's showing is how correlated are those assets. So this is showing you the correlation between the S&P 500, a broad US index of stocks, and the price return of a 10-year treasury bond. So the shaded region in red are basically when stock and bond prices move differently. That's what you want when you're building a diversified portfolio. You don't want your stocks down and your bonds down nearly as much because it's not helping you. Sometimes the economy is going through these cycles where the primary risks can be different. And so during periods of high inflation, we know that typically to stamp out inflation means you need to raise rates, which is not a good thing for bond holders. And so you have price losses in bonds. In addition, it's typically not a great environment for stocks. So it can be a difficult time. One thing I would say is because we are potentially on the precipice of that first initial cut, and because some of the signs that of a soft landing are looking more likely, is bonds may be your friend again in not too long. We still think there's some volatility that remains, and in part of the portfolios that we manage, we still actually have some alternatives that we use to replace some of your bond positions. But I think the investment experience of bondholders over the next 3 years is going to be a little bit better than what we've experienced over the past 3 years.
No, it's a great point, John, and I think a good way to kind of wrap up in terms of expectations from a broad market standpoint going forward. So with that being said, we do have some takeaways here on this slide. Just gives you an overview of kind of what we've covered over the last, call it 30 minutes or so. But with that being said, we will kind of open it up for any additional questions that have come in. So don't hesitate to use the chat feature, the Q&A feature there. I know there had been a few questions that had come in prior to the webinar that Mike and Regina had kind of written down. But one, maybe John, that I'll start with and then let them chime in as well is, okay, we talked a lot about stocks and bonds in different areas of the market. One thing we didn't talk really at all about was international stocks. Maybe help us kind of think through, hey, is there a time, should we be looking at international stocks? Maybe why should we or why should we not be thinking about those?
Yeah, I think if you want to achieve diversification, part of your portfolio, if you're managing an all equity portfolio, should include international stocks. So that would include emerging market stocks and also developed international stocks. So think European stocks, for instance, or Japan. I recognize that holding international stocks over the past few years has not been rewarded, especially relative to the growth of US stocks. But it's important to recognize that these things operate in cycles, and we are in the midst of a record cycle of US outperformance. the way our portfolios at Horizon are currently positioned are to favor a US overweight to ensure that we are providing the right allocation to those large cap names. But we do also include emerging market positions and international developed stocks as well. Will also just point out, like, there are risks, right? China kind of seems like a mess right now. It's important to be aware of those risks and to manage through it. So to reiterate, we still believe in maintaining a global diversified portfolio, but we recommend favoring maybe more of a US allocation at this point in time.
Good stuff. Ryan, Regina, Mike, anything, like I said, I know you guys had some questions that had come across ahead of time. Anything that you guys would want to pick John's brain on here before we formally wrap up?
Quickly, I just wanted to thank John and Austin for both doing a great job. Great economic update. Great, I think, on the political climate, because those are both topics that are front of mind for everybody. But one thing I thought was really interesting that I took note of was that back in the 90s, where we had the internet that helped productivity while we had 6 to 8 years of rising interest rates. Right now, we're in a very similar period, and we have AI with a period of rising interest rates. It seems like we're at a similar inflection point in time, and that was a decent economy back in the 90s.
Absolutely.
Yep.
I think you're absolutely right, Mike. John, maybe one last thing I know that's come across is, as you talk about AI, something else that maybe kind of caught some headlines, maybe starting a couple years ago, right around the same time as this idea of cryptocurrency. What's Horizon's view? Is that something that should be part of a portfolio? Like, how do you play that asset class, if you want to think of it that way?
Yeah, it's a really good question, and we do get it often. I think if you're going to allocate your portfolio to include crypto, you should view it as an ultra speculative large growth stock, because it is as volatile as a large growth stock. Now, you may experience some really tremendous upside in a short amount of time, but just as short and tremendous as that is, it can be on the opposite end of the spectrum too, where it can be a difficult hold through large and frequent drawdowns. So from a portfolio context, I would view it as a really ultra speculative growth part of your portfolio. I do think with the emergence of some of these ETFs that have come out, it has made it a little bit easier to invest. That I think you don't necessarily need to have a privately stored wallet with crypto assets. But feel free. We get this question quite often. I'm personally happy just maintaining stocks allocation. I think that's as volatile as I need it to be, but I certainly recognize it. The interest in it, especially from folks of my generation.
Hey, John, piggybacking on that, many of our clients often talk about downside risk, downside protection. We don't try to market time. We've said that over and over again.
Yep.
That's not the way that we manage portfolios, nor do you. But you do have some allocations that focus on that can be defensive in times of volatility. Could you touch upon that just in regards to folks that are in what I would consider either the preservation or the distribution phase, maybe having some type of an underlying safety net on their assets?
Yeah, it's a really good question, and managing risk is paramount to what we do. If you were working with someone like my age, I know that I'm going to experience probably 10 recessions before I retire, and I don't necessarily need to have so much of my portfolio dedicated to quote unquote risk management. I really just need to continue to save and invest. But for those folks that you mentioned who are thinking about retiring in the next 3 to 5 years or are already in retirement, losing a third or 40% of your portfolio could have some really large, drastic impacts on your financial plan. So we think that it makes sense to employ guardrails in your portfolio to prevent that catastrophic loss from happening in your portfolio. So we actually use a few different ways to mitigate risk that we'd happy to kind of continue to talk through, but it is just about kind of stopping the bleeding before it gets too bad. And then also the last thing would be, to your point about timing, when you're in the midst of a large drawdown, selling out of your portfolio is the easy decision. You feel like you're doing something, you feel like you feel better about it right away. But the problem is knowing when to buy back in is so difficult. And before you know it, the market can actually rebound to 20, 25%, and you didn't participate at all. So we think that's important consideration too.
I know a lot of our clients are concerned about geopolitics, the things going on around the world. Is there any one area around the world right now that you're concerned about? China, North Korea, the Middle East, you name it.
There are a few different areas. I mean, obviously, with some of the recent Middle East tensions brought about a lot of, I guess, narratives about energy exports. I would just say that on a global scale, and certainly with Russia, Ukraine, these aren't huge contributors to the global economic output. And if you're really concerned even about it as living in the US is actually a net energy importer, or exporter rather. So we actually are a lot more energy independent than we have been in years. And I think it's important to consider that. But just to reiterate, with some of the global tensions, you're just going to have to be an investor through many global tensions, and there have been for so long. What I would just reiterate though, and also maybe you can help out too, is with some of these players like Iran, Russia, they're just not as important as maybe they once were, and they don't play a huge impact on the global scale.
No, I think that's absolutely right. And Mike, to echo John's point, like the way that we're looking at it here at Horizon is, yes, it may create some headline volatility, and it's obviously very, a sad situation in a lot of different places around the world. But as John mentioned, from an economic output or an economic perspective, or even a market perspective, if you look at global marketplaces, the places where you're seeing those tensions today just really aren't big kind of participants in the global economy. The one maybe that there's some uncertainty about is the China-Taiwan situation.
Yeah.
And that's one that obviously China being such a big player of the global economy today, there's some unknown there. Obviously, you haven't really seen that come to a head at this point. So that's one that we're watching pretty closely. But even, and I would kind of build on what John said in terms of, China is actually a smaller player today in the global economy than it was pre-COVID. So with a lot of the supply chain disruption, you actually saw whether that was bringing things back to the US or finding other distribution partners around the world, you actually saw the reliance on China come down. So I say that because, again, there's less and less exposure today than there maybe has been in the past. But that's the one that maybe is potentially going to have more of an impact. And I say potentially, again, like that's the one that really hasn't come to a head as of yet. So
Awesome. Well, the last one I had, and we know we get it all the time in our meetings, if somebody wanted to, in their own play account, go into the AI field, where would you start them off? What are you thinking as far as individual companies that may play in the next wave of AI?
We will not hold you to this. Because we tell our clients we're not stock pickers, and we're not going to hold them to it.
I also want it on the record that my question was just stolen.
It's a really good question. And I do think you would absolutely need exposure to semiconductor names. So like you would need exposure to NVIDIA. I wouldn't put a lot of your portfolio in it because it's the run it's had. It likely doesn't mean it's going to continue running as strong as that is, but you'd probably want exposures to some of these semiconductors. You'd probably want some exposure to cloud computing. So that's going to be your Oracle, Alphabet, Microsoft, Amazon. I think something that our team has been thinking through is what are some other phases of AI that it could be impacted. So one sector, for instance, could be utilities. So you're going to be having you're going to have a huge energy need for these data centers that are already existing, but also already being built, that the utilities are going to have to provide for that. And that may be a good boon for the utility sector. And the last thing could be just additional mining companies and metals companies. So the raw materials that go into these processes, right? Lithium and copper, and then all the hardware that needs to be built too. So that's another way I would think about this.
Yeah. And,
Okay, great. Thank you very much.
Mike, one thing I would say, everything John just said, I would completely echo. But the other thing to think through, and this maybe goes back to the comparison to the internet boom that we saw in the 90s, is start to think through what companies will benefit from AI and how will they benefit, right? I mean, I know we've had the conversation about how you guys are thinking about incorporating AI into your practice, right? How will it impact just kind of everyday parts of the economy, and where are places that will be able to take advantage of that? Again, you look back to the early 90s, yes, a lot of the companies that benefited early on were the technology companies. But look, today, everybody's got a website. Everybody broadly does something, some form of, whether it's, advertising or selling on the internet has become, something that everybody touches. I think our view is that AI eventually becomes the same way. And to the extent that you can be on the forefront of that in terms of companies that are learning how to use it, I think that's where you get that uptick. Let's say maybe not today in the first phase, but in the second and third phase going forward.
Very good. And I think everybody on the call knows our former partner, Jack McGrath. And as we're experiencing increases in productivity, we're doing our best to avoid layoffs, Ryan.
I thought I was just about to get some bad news over the call.
That was Jack's favorite saying. We're trying to avoid layoffs here. We are not going to be using computers to replace people. So everybody needs to know.
Well, and Regina, I think that's an important point. We're not necessarily saying that AI has to replace individuals. It's a question of how does it make us all more efficient, right? So
Absolutely.
I think, yeah, how do you get folks that are able to leverage that technology?
Mm-hmm. Yeah, and I think as a team, we completely agree with that stance, and we are hoping to push AI as much as we can within our own business and help our own efficiency,
Sure.
which in the end will just help our clients. So
Yep.
it's a win-win for all.
100%.
Cool.
Well,
Okay.
I think this was a resounding success, and I hope this is the first of more of these to come in the future. We look forward to it.
Thank you, guys.
Guys, we really appreciate it.
Thank you all. And thank you to all of our clients who are truly part of the strategic family. And we're wishing you a rest of a great summer. It's been a hot one. So go out and have some fun and take some time to smell the roses.
Thanks,
All
guys.
right, guys, take care.
Take care.
Bye.
Bye,
Bye.
everyone.